We're coming up on the end of another really good year in the markets. And I think this is a great time to reflect on, does your portfolio allocation still match up with your financial plan? The markets have been kind to us this year, and even though we've experienced a little volatility here in the recent months, it does look like we're ending the year on a high note. And it got me thinking, this is really the time when we start to see emotion creep into portfolio allocation. And what I mean by that is some people start to think that maybe they're missing out. We should push more dollars into equities. We should get a little more risky. So what I wanted to do this week was talk about why we start with understanding what your financial plan looks like and what your portfolio needs to be crafted to do. And from that perspective, we really want to understand what we call the risk budget. So for many of you, especially if we've been working together for a while, we went through that process of understanding what your plan needed your portfolio to do. And by that I mean, how are we going to get from the here and now in your investment life cycle to where we want to be long term? We're coming off of a decade, 2010 to 2020, where the US stock market returned in excess of 12 to 13% per year. That is above average. If we think historically, what should the 100% stock market here in the US give us? It's more in the 8 to 9% range. And we as humans tend to have very short-term memories. That being the case, I'm starting to have a lot more conversations with clients around, is this the new normal? Are we going to get these double-digit returns year over year? And as much as we love a year like this year and some of the years we've experienced recently where we are getting those double-digit returns, we know that that is not historically normal. Now, I'm certainly not saying that we're in for any kind of large downturn in the markets. We know that volatility is normal. We get ups and downs. Markets are efficient. But I do think we may be entering a decade, and a lot of analysts and people way smarter than me agree, where we may see more muted returns in the equity markets. So that ties back to the initial thought here, which was making sure that the allocation that you currently have in your portfolio matches up with what your financial and retirement plan needs to give you for the long term. So as you're thinking through that idea of math and emotion, understanding if you are starting to feel like maybe I want some more equity in the portfolio, or I want to be a little more risk on to take advantage of these good markets, understanding where is that coming from? Is it a fear of missing out? Is it truly a math, I want better returns? And does your plan necessitate doing anything different than you've done so far? I think for a lot of people, what you really need to think through is the idea of what part of your portfolio are you talking about? Certainly, when we look at the difference between investing and speculating, we need to make sure that the investments are rounded in a way to where we know those dollars are going to sustain you for the long term or get you to where you want to go. When it does come to that area of the portfolio that may be a little more outside of the box, and for some of you, you don't want that, you don't need that, and for others, you may be looking at those dollars as earmarked for something different. It's the long-term inheritance money. It's the dollars that you're not going to touch for 20 to 30 years. If that is the case, maybe that's the area that you want to re-look at in terms of the allocation and what you want to see out of that portfolio long-term. But for a majority of you, it may be a good time to just check those emotions and understand if my plan is telling me that I am allocated in the appropriate way, there maybe isn't a big need to change that at this time. Again, we're thankful for the market returns that we've got, and we certainly expect that markets will be efficient going forward. But there was a study recently that started to give me pause when it came to how the average individual is looking at average returns. They've done a study recently looking at different age demographics in the US, and the average 30-year-old right now believes that long-term you should get 18% from your portfolio. That's when I start to get pause as people start to look at maybe unrealistic returns long-term. So as we move into 2022, and I know for a lot of you, this is the time of goal setting, New Year's resolutions, and what's coming next. Part of what I think you should be thinking about is, does that portfolio allocation you have match up with your plan? If you're a client of ours, it's probably a discussion that we've been having all throughout the last year, and I can assure you, more than likely, you're allocated appropriately. But if you still have questions, or if you're not a client of ours, this may be the time to start thinking through that. Reach out, let us know how we can help. Have a great week, everyone.